we still in a long-term bull market, or have we entered a new long-term secular bear market? I get asked the question of a question like this: is this a good time to buy? Is this a good time to get back into the market? Or should I be getting out of the market? And those are not the questions that should be asked, and I will cover that. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 25th, 2022. I covered this some last week, and I want to go a little more into detail on it this week because I've been thinking about it a lot. When people ask the question, is this the time to buy? That is a bull market question, because for the last 12 years, 2009 to 2021, investors have been used to the idea that the market comes down a little bit and then it goes on back up. That's a bull market. And it generally speaking has had one trajectory, and that's been up. And so this mindset that's in people's minds are, should I buy now? Should I put more money in? Or I have money in my savings, should I put it in the market now? Is a bull market question. The other question that I get asked is, should I get out of the market? Because people are seeing risk, they're seeing their accounts are down, and they're hearing comments that this is going to get worse. And they have evidence that it has gotten worse. So they don't really know what to do. And before you can ask those or answer those questions, you have to ask another question. The question is, what is the environment that we're in? In other words, are we in a long-term secular bull market, which we've been in, or have we entered a new long-term secular bear market? If you can answer that, then you can ask the next question of, what should I do? Should I buy or should I sell? You see, long-term bull markets and bear markets tend to go for 10 to 15, maybe even 20 years. And during that period of time, there are short-term cycles. They're called cyclical bear markets and bull markets inside of that long-term trajectory. And I believe that we have entered a new long-term secular bear market, and I will explain why. And that we are in fact not in a bull market. But if you have the opinion we're in a bull market, I will address what I think your options are, and then I will talk about your options and how you should view it if we're in a bear market. Here's why I think we're in a bear market, or that we're in a long-term secular bear market. Because the characteristics that existed, the economic characteristics, financial and economic characteristics that existed during the 12-year period of 2009 to 2021 were an environment of low interest rates, low inflation, and low yields on bonds. And generally speaking, most of that time, bonds and bond funds had an upward trajectory. In or around January of 2022, things changed. Inflation went from 2% or whatever it's been, very low level for a long time, all of a sudden began to go up and go up fast. And now we've heard, inflation 8 and 9%. And in some countries, it's beyond 10%. The Federal Reserve was slow to act, we know that, but as a result, they have now got on board and are aggressively and frequently hiking interest rates. And they've signaled that they plan to do that into the future for a while. So we've gone from this very low level inflation to higher inflation, low level interest rates at or near zero, to elevated interest rates with the sign that they will probably go higher. Bond yields, the same thing, very low level, and now all of a sudden bond yields have spiked up. So when you look at the characteristics like that, that is very different from a bull market. It is now signaling for a variety of indicators that we're headed into a recession. So we're headed into a recession. We've had a pullback in both the stock market and the bond market, increasing interest rates, high inflation, increasing bond yields. That all signals to me that this is not a correction and part of a longer-term bull market, but in fact has the characteristics of a bear market. So the question I asked is, how can you get out of this mess that you are in right now? If you're one of our clients, you don't have to worry about that because we're managing your money and we're managing that risk. And I told you shortly after January 7th that on January 7th, we got out of the market. We've been out of the market most of this year. We were fractionally in it for some period of time, and then we got back in the months of March and July when the market went back up again. And then when that didn't last, we got back out. And we've been out now of the market for, I believe it was since the 23rd or 24th of August. So, and we're not ready to get in, but we will when the market gives us an adequate signal to get back in. We'll get back in the market, but not at this point. So if you are not a client, if you manage your own money or you have an advisor manage your money, mostly I'm doing this for you. So you may think, okay, you've been fully invested. However you manage your money, you've been fully invested. That's a traditional approach. And a lot of times that traditional approach includes stocks and bonds or bond funds. And you have seen that both of those have declined and declined a lot. There was not a collapse, really. If there was, it was probably more in the bond market, but it was just a steady decline, just eating away, day after day, week after week, month after month, and eating away at portfolios. And so it has left investors very frustrated, sort of surprised. Where did this come from? Traditional financial advisors do not have a good answer for this. The answers that they have given that I've been told have not left people very satisfied. So, but they don't believe in an approach that where you get out of the way when you see that kind of risk coming. They just believe in riding it all the way down. They also believe in the concept that bonds are going to counter equities or stocks. And so when stocks go down, traditionally, bonds or bond funds have gone up. And that hasn't happened. So that really leaves them perplexed because the traditional model they've used, as far as I can tell, has failed them and it's failed their clients. So what do you do? How do you get out of this mess? Here's how I see it. If you define the market as a bull market, then you would say we have had more than a dip. We've had a pretty big decline, and probably now would be a good time to get in if you have a time frame that extends to the end of whenever this bull market occurs. However, we've got a lot of that bull market behind us, so it's getting pretty exhausted. So, but if you believe in a bull market, I'd say, yeah, now's as good a time as any to get back in. If you think this is the beginning of a bear market, you have to kind of flip that question around and don't think of buying. Think of when the market rises from here for a short period of time, which I believe it will, it'll go up for a little bit, and then if it's a long-term bear market, it's going to continue to collapse and go on down. And during a rise in stock prices, strength in the market, that would be a good time to sell. So think in terms of selling on strength instead of buying on weakness. Kind of, you just have to look at it in an opposite kind of way. And that would be the way I would get out of the mess. Either, satisfying whatever you believe the market is, whether it's bull market or bear market. This is a depiction, a stylized version. It's very perfect, so it's obviously not the way the market works, but it makes the point. You have two general trajectories. On the left side, it goes up. That would be a long-term secular bull market. Inside of that long-term market are short-term cycles, and you can see those. Conversely, when you go to the other side, on the right side, you see the long-term secular bear market. Both of these exist. They come about at certain times, and they last, as I said, usually for 10 to 15 years, maybe a little longer. And they have cycles within them like this. I wrote the question, or the comment, on the left. We could be here. So if you believe this is still part of the long-term secular bull market, we are toward the top because we've got this 12-year period behind us. And it's a dip, part of a longer-term cycle. Or we could be here in the center of this triangle, kind of toward the top. But we have one more segment to blow off the top before it heads down. So that could be true. Or we could be here on the right. We could have already started down, and that first decline in the cyclical red line, that first decline down is what we just experienced. And if it is, if we're in that long-term bear market and that first leg of this long-term cycle has occurred, then that would be about where we are. And there would be times where we will go up from here and times we will go down from here. But the general trajectory over a long period of time, decade to a decade and a half, will likely be a downward trajectory. When you translate that to real time, to an actual stock market, I showed you this last week. This is a 150-year chart showing the actual or simulated S&P 500. And it, in the red, gives you the bear markets, and the blue gives you the bull markets. So you can see these long-term, usually 10 to 15-year cycles that occur, particularly in the bear markets, and the bull market sometimes can go even beyond that. When you see this red line that goes down, the bear market, it's very uneven. It's messy. They all behave somewhat differently, but they all go down. If you look at the Great Depression, that was particularly messy. On the far right side of the chart, you see the last red segment of the line. That has two dips in it. The first dip was 2000. The second dip in that line was 2008. And they were all part of that 9-year period, was part of that long-term secular bear market. When it finished in 2003, the first leg of that, when it went down at that dip, when it went down there, it was not done. So it still had more to go, but it did have a relief rally that went actually for a few years, and then it eventually collapsed. It was not done washing the excess out of the system. So again, it's a messy process. It is very hard on investors. If the 2000-2003 market did not rip enough emotions and money away from investors, the second one in 2008, 7, 8, and 9 did. If you go back all the way to the Depression, the Great Depression, kind of at the center of the chart, you can see, now that one lasted 20 years, okay, from 1929 to 1949. And boy, was that messy. I mean, it went down and it went way up and it went way down, just on like this, just tearing people's emotions apart, and then leaving them, if they had any money at the beginning, probably not much money left at the end, and a lot of ragged emotions. I've been talking about stocks and the stock market, and I'll talk more about this later, but I've talked a lot about bonds, and it has been especially a very hard year, actually for 2 years. It's been a couple of very hard 2-year period for bonds, but this is just 2022, the long-term government, 20-year long-term government bond has declined a lot, has declined through Friday from January 1, about 37%. So that was no help to investor portfolios. Now, there are other kinds of bonds, and we'll cover some of this later, but that just gives you an indication of how harsh bonds have been on portfolios and on investor emotions. Now I want to jump over and go into some economics, some numerous economic indicators, and we'll talk about that, and we'll get into the charts later. The Philadelphia Fed Manufacturing Index goes up and down. It's an indication of the manufacturing sector in our country, and you can see where it's come from in 2021 and where it is today. So not a very good picture, and it was down more than was expected. It was expected to be -5, and it was down 8.7. The next is the Philadelphia Fed Manufacturing Outlook. This is a survey that project, what is your view of the future? And as you can tell, it's not very good. The Conference Board has the leading economic indicator index, and you can see in 2022 what that leading index has said, and it's been pretty much in straight decline this year, month after month, and this is through the month of September. I want to go over to housing. In the housing sector, that has started to weaken. Now, there are some markets where it is stronger, remains stronger, but there are other markets that are clearly starting to show weakness in sales and in prices, and this is an indication. It's a national chart. It doesn't break down by region, but you can see, and it's through the month of September, down 21%. Now to go over to bonds. Bonds, and of course I showed you the long-term government bond. This is the bond yield. Now remember that bond yields go in an inverse direction to the bond prices. So I've shown you, so if you could imagine in 2022, if you could isolate this line, you could say, if we could reverse that, it would be pretty similar to that previous chart I showed you. That was the red chart with the long-term government bond ETF. But you can see where bond yields have come from and where they have gone to. Now this is the 30-year government bond. I wanted to draw your attention to the rate. The yield on this 30-year bond is 4.22%. Okay, and it came from down around 1 or 2%. Next, I want to do the 2-year government bond yield. So again, as this goes up, so do bond prices go down. So when you see where this came from, mostly this year, you can see that it is just going sky high, even more so than the 30-year. But the pattern is somewhat similar. The yield on the 2-year is 4.57. So, from the relationship of the 2-year and the 10-year, if the 2-year has a higher yield, than the 10-year or the 20 or 30-year, it says that things are out of whack. And that is a primary indicator for a coming recession. So just think, in terms of bonds or bond prices, the inverse of this chart. Okay, the estimated through the Fed Fund futures that they are estimating that I'll show you two charts on this. They're estimating that based on where people are putting their money, their estimate is that the Fed funds rate will probably cap out at around 5%. It's changing. They change, it seems like every day or every week, that they're constantly, based on indicators, raising it or lowering it. But right now, it is estimated that the Fed's fund rate will probably cap out at around 5%. We don't know yet, but as we get closer, we'll find out. But we're not there yet, but we will see as we get closer. This chart shows you, this is sort of a curve showing, going back to, we're starting this current month and estimating for the future that where will the Fed funds rate cap out. And you can see the red line is what I just showed you at around 5%. Following that, they estimate that it will slightly decline. But it's not going to drop off quickly. They're not going to reduce rates, or at least they're not planning on it at this point. Compare that to the blue line, which is 1 week ago. What was the estimate a week ago? Less. So maybe if we carry this out for another month or a couple of months, these lines are going to look different. But it's just showing that the trajectory is up, and it's probably in the neighborhood of 5% unless there's new data that supports a different conclusion. Go over to jobs. The initial jobless claim rate, now this is this year data compared to the average of 2018, 2019. So this would be the change from the pre-pandemic level. And you can see, this is good news actually, you can see that through that blue line, or the blue bar on the far right, that the jobless claims have continued to go down, which means that people are fully employed. There is not signs right now of a weakening job market. And so while we've got all kind of indicators that the economy, housing, interest rates, bond deals, et cetera, manufacturing index, a lot of indicators are saying we're headed for a recession. It's not yet showing up in the job market. Will it later? Probably. But at this point, I would say this would be the good news in the data. Now, if this shows the wage growth, where have they been better off getting an increase in wages? Staying with their current job or changing jobs? And it plots this over a period of time. This goes back to 1998, and they're somewhat similar for quite a bit of time. But look at what happened, particularly in the last year or two, that all of a sudden there is a pretty big spread. And it shows that people have actually got higher growth in their wages by changing jobs. They've gotten an increase by staying in the same job, but not as much as from changing jobs. Interesting data. Flow of funds report. This is for last week, and you can see that the equity funds have had a net outflow of $5.5 billion. Bond funds have had a net outflow of 6.8, and money market funds have had a net inflow of 5.7 billion. Okay, and get to the dashboard reports. Last week was a positive week for the market. There were 3 days, I believe, of positive gains, excellent gains, and there were a couple of days that were down. But the net effect was positive. In all 6 indexes that I track, all of them crossed up over their 20-day moving average, as you can see from the green dots. They're all still below their 50, 100, and 200-day moving averages, as you can see from the last 3 rows of red dots. The bottom line is TLT, which is, we've just talked about it, the 20-year government bond, and it is continued to go down, and is still below, well below, its 20, 50, 100, and 200-day moving averages. So if you look on the numbers in the center of the page, you can see the change. The first column is the change on Friday, the change for the week, the change for the month, the quarter, and the year. On the year to date, the Dow down 14%, S&P down 21%, it was 24% last week. IWM, the Russell 2000 small cap index, down 22%. The foreign developed markets down 26%. The emerging markets down 27%. NASDAQ 100 down 30%, and it was down 34% last week, so improvement in all of those indexes. But the 20-year government long-term bond was down 35% last week, year to date. Now it's down 37%. Not looking good. The S&P 500 has 11 sectors in it. This is a sector chart showing where these 11 sectors are relative to their 20, 50, 100, and 200-day moving averages. If it's above the moving average, then it's a green dot. If it's below, it's, that would get a red dot. So you can see that there are 12 green dots out of 44 potential 20, 50, 100, and 200-day moving averages. And there are a couple of them that are still below all 4 of them. And energy, as has been true for the year, has moved up. So it is now a gain of 56% year to date. Energy, which is basically oil. And everything else is negative, going from minus 10% to negative 34%. Pretty interesting. So inside these averages, when you look at something like the S&P 500 or any of these indexes, there are stocks, and in the S&P 500 case, there are numerous sectors, and they can be all over the map. So, okay, the S&P 500. Let's get to some charts. This is a 1-year chart, a weekly chart showing 1 move equals 1 week, and the move up at the far right of the chart, and that's the move for this week. You can see it was a positive week. It moved up, but the long-term trajectory for the last 9 months or so is negative, still in a downward trajectory. And on a weekly basis, not a daily basis, but on a weekly basis, the S&P 500 is still below its 20-period moving average. When we take the S&P 500 and we break it apart to growth and value, there are growth stocks in there and there are value stocks in there. And we separate those out and then plot that on a ratio, growth meaning numerator, value meaning denominator. And if it goes up, that favors growth. If it goes down, it favors value. So for the last 12 months, you can see on a weekly chart that the long-term trajectory has been down, which means that value has been more in favor than growth. I'm going to take this from a 12-month chart out to a 24-month chart, just so I can show you the magnitude of this. This puts the Russell 2000 small cap index, the ETF is IWM, relative to the S&P 500, SPY, and SPY is the denominator, IWM is the numerator. And what that means is that if this goes down, that favors large cap, and if it goes up, it favors small cap. So you can see at the very beginning, for the first few months of this, small cap was definitely in favor, and you can see for about 20 months that the large cap has been in favor most of the time. Now, this is an absolute chart. It's what we talked about before, TLT, which is the 20-year government bond. And I stretched it out to 30 months so you can see both of these periods of time. And you can see that they're the trajectory is down. Back a couple of years ago, you can see where it went down the first time, then it tried to go back up. This is a typical bear market pattern. Tried to go back up and couldn't because there was still too much excess in the system, bonds, and then the collapse began. The only word I think about when I look at this chart is this is a horrible asset. Today, there have been times where it's been very good, but we're in an environment where bonds, and in particularly high quality government bonds, are getting shellacked. And even the high yield bonds, the junk bonds, are doing better, or I should say are down less than the government bonds. So quite a paradox. So I take that's the 20-year. Now I change it to the intermediate term, which is the 7 to 10-year government bond, and the ETF is IEF. And you can see same pattern, except it's a little different. And it still has these same two periods, and how it moved, it made some attempts to go back up. A lot of investment portfolios have both of these, both the long-term or the intermediate-term government bonds. And then when you get to the short-term bonds, this is the one that had the yield of 4.57. Look at that. I mean, that is a horrible, horrible chart. And so way below its 20-period moving average, and clearly in a downward trajectory. One day, it'll go back up, but it does not appear anytime soon. Gold, the ETF is GLD, and this is a 48-month chart. So you can see for over half of this period of time, over 2 years, that the long-term trajectory of bonds is down and is below its 20-period moving average. Prior to that time, it's kind of a story of two moves, I guess, in the market. Prior to that time, it was on a tear going up, and then it has retreated since that time. If we look at silver, kind of the same thing, except the moves up and down are a little bit different. But the downward trajectory you can see. You also can see this last week was good for both, slightly positive for gold and definitely more positive for silver. So you can see that move up at the very end. It's still part of the long-term trend down. When I plot these, showing silver as a numerator, gold as a denominator, see the relative difference or relative strength of one versus the other. If it's going up, as you can see from the first part of the chart, that means silver is going up faster than gold. If it's going down, it means that, as you know, they are both going down, but it means that gold is going down less than silver. Silver would be more out of favor than gold. But at toward the very end, you can see there appears to be, it's moved up over its 20, the ratio has moved up over its 20-period moving average and seems to show some strength, which would favor silver. So the last chart is the volatility index. It's called the VIX. And it is felt that if the VIX is above 24, that's a period of higher risk or higher potential volatility. And conversely, if it's below 24, it's probably a period of less volatility. So you can see where that 24 number is. I marked with a black line, and it's still at 29, so it's come down some, but it's still, I'd say for now, it's still a period of higher volatility. Asbury Research does measures 6 metrics in the market, and 3 of those, it's kind of mixed right now, and as you can see from the market, it's mixed, and it's 3 are positive, 3 are negative, and we'll see where this goes. It's been all negative for the past several weeks, so we'll see what this next week brings. Gold and silver, as I said, gold was up slightly. It's up 0.6% over the previous week. It's at $16.59 per ounce. This is spot price, so the markup is on top of this. Silver, the spot price is $19.37. It's moved up 5.8% from this past week. It was down quite a bit the week before, so it tends to move more dynamically, both up and down, than gold does. We're in the baseball season playoffs. If you follow baseball, you like baseball, there's some good baseball out there right now during the playoffs and then the World Series. And as I think about baseball, I couldn't help but think of Norman Rockwell. And he painted many paintings that were around the theme of baseball, but mostly the themes were around the American way of life. And he was born in 1894, he died in 1978, but his productive years of painting were 1914 to 1970. So during that period of time was really the great era of baseball. And so this is one of those paintings. And as I thought about the playoffs and watching some of the upsets and so forth, I couldn't help but think of Norman Rockwell. If you have comments or questions, leave them in the comment section below. I'll try to answer them. Thank you for watching.